Gurmeet Chadda, managing partner at and CIO of Complete Circle, joins in. Gurmeet, what a day, right? India's striding ahead. Valuation-wise, we're not cheap. But just looking at the screen, looking at the Asian markets that were under pressure, Nifty is in the green now. Nifty Bank is flying away. Overnight, if you were tracking the SGX Nifty and the Dow and all, you would be really disappointed. What are you making of this market?
Nigel, tremendous resilience. I think I don't recollect seeing Nasdaq down 5% and Indian markets putting up a decent show. Probably, we sometimes maybe there is some news which probably is macro news which is around the corner. I don't know whether it is inclusion in the global bond index, inclusion, increase in weightage in something. There's probably something which could be the case, which probably is going to price. Also, I think the index could also be a little misleading in terms of while obviously it's a smart recovery. I think the market is probably differentiating in terms of things which will do well and things which probably be under pressure. Like IT index is still 3-4% down, for the leading names being down, and Bank Nifty's made a new high. So I think the market is differentiating where earnings support would be and where probably margin pressure would and inflation pressures would continue. And mind you, they have pulled out $50 billion and pumped back $6-7 billion only. So also I think the positioning is also much lighter. So some of it could be related to that, but I think maybe some macro event is probably around the corner, which probably would reflect once these sometimes price action precedes that.
Maybe I'll throw a line your way with what someone told me half an hour back. पाजी कुछ तो इज्जत रख लेते US market की. just amazing, right? But you're right. I mean, that bond index inclusion is perhaps, I mean, we could hear something this month. So yeah, you're right. The other thing about the weight itself for stock indices, that, I mean, the weight itself, of course, changes as markets become bigger and grow, so the weight automatically increases. But this does seem to be, as I was saying, dedicated inflow, very deliberate inflow for India because of what other emerging markets are doing or not doing. They're doing very badly. I put that piece out in detail 2 weeks back. That seems to be a very logical explanation. Otherwise, with this kind of global environment, very chunky flows coming in, it will baffle you. So, Gurmeet, what are you doing? I mean, you're raising money, you're deploying money, you're getting new money. I mean, it's not an easy place to be a fund manager. To comment is easy, but to put money to work as markets continue to gallop higher is not easy.
No, it's tough, Prashant. So we're maintaining about 10-15% cash. We are not out of the market. I think that's a prudent thing we did. And as I said, there are opportunities. You probably have to be a little contrarian at the same time. Do not get carried away. So, if 10-year US continues to inch and cross 3.5 and maybe get closer to 374, there will be some repercussions because the discounting rate goes up. And the first thing you need to do is don't overpay. I think in a market like this, the worst mistake you can do is pay. So even in IT, for example, we were discussing, while the index is down, you are still at 25-30% premium as far as pre-COVID is concerned. So within IT also, you have to be careful in terms of, I think better clarity will come once the earnings come. But maybe if you're getting good names at 14, 15, 16 times earnings, maybe you can gradually start nibbling into them. It happened with auto, if you recollect, a few months back, when there was all negative news in terms of disruption, supply chain, semiconductor chips, and stocks slightly moving up. So this market probably got to be a little contrarian, pay more reasonable valuations for the multiple, and maybe keep some powder dry. Opportunities will just keep coming, as I keep saying. And once the earnings season start, I think differentiation will happen, and from there on, probably it can become a more stocks.
Gurmeet, I mean, that is a space, right? Now, take the case of IndusInd Bank. It's a large bank. Of course, I mean, not top tier, maybe second tier. Still far away from its pre-COVID levels. Valuation-wise, it's kind of cheap. I mean, it's just rotation, right? Which seems to be at work. Your thoughts?
So, Prashant, I think what has happened in banks is, as you said, there is a rotation happened. There was a time when HDFC Kotak IndusInd also at its prime used to get 4 or 5 multiples. And there was City Union Bank, for example, right? Used to command higher multiples, and there were banks which were struggling to even get book value. Probably there's some mean reversion happening. As you can call it rotation. Even HDFC Bank, for example, if you see the PAT in 2019 was 19,000 crores, and last year they did 37,000 crores. And the price virtually is for 10-12% up in 3 years, right? So, but and I've not seen HDFC Bank below 3 book multiple for a long time. But that 4-5 multiple came for premium credit quality, 20% plus credit growth, which now a lot of banks are matching up. So example, SBI, Abhishek made that point, making a new high. If you see the operating metrics, see the credit cost last quarter, 61 basis points. See their slippages. They continue to moderate. I have not seen net NPA of SBI 1% for a long time. In fact, I was seeing their restructured pool, their SMA1, SMA book looks pretty good. Their advances at that size of the book, is 16% growth. I think what you will see now in banks is a huge liability war and a rush to raise deposit because credit growth is 15-16%. So bank with automatically high CASA, 45-50% CASA, which is ICICI, HDFC, SBI, even Axis to an extent, will start, gaining more, both in terms of NIMs, both in terms of HDFC, for example, would need huge deposits just because once the merger goes in. So we still like ICICI, SBI, HDFC, continue to be our portfolio stocks. Also, we like some of the banks at the lower end where we are seeing, the books becoming granular, like IDFC First now, the infra book is just 5% now. Retail loans are almost 70%. Deposits also, they are doing well. CASA, they are doing pretty well. So some of the banks there, we are just beginning to, starting to, nibble it.
Okay, all right, Gurmeet. Let's focus on the sector that's getting clonked, the IT sector. That's in focus on the back of the negative commentary coming in from Goldman Sachs in its recent report. Nimesh alerted us about that. He's joining in to fill us in with more details. Nimesh?
Hi, Nigel. So there are two reasons why the entire IT basket is under pressure today. One, of course, last night Nasdaq was sharply down 5%, and there are now global concerns. And two, today Goldman Sachs put out a note, and they've downgraded the top-notch Indian IT names. Now, they believe the valuations of Indian IT companies are still very expensive, and there is a clear signs of down cycle going ahead. In fact, so they've downgraded TCS, Infosys, and Tech Mahindra to sell, and they've marginally upgraded Wipro to buy. Now, they believe the dollar revenue growth for the top Indian IT companies are going to materially slow down from here on. So so far FY24, so calendar FY24, Goldman has cut the revenue growth estimates by 4 percentage points to 6% now versus their earlier expectations of 10%. And the price to PE multiples are still very high for most of the Indian companies, and they are not factoring in the growth slowdown. In terms of individual recommendations, Goldman has cut the target price on Infosys to 12.22 now versus the earlier target was of 17.22, and they've cut the FY23, FY26 EPS expectations by 6%. On TCS, they've downgraded the stock to a sell with a new target price of 2,611, which is way lower than the earlier target price of 3,678. Even for TCS, Goldman has cut the FY23, FY26 EPS estimates by 5%. On Tech Mahindra, they've downgraded the stock to sell now from neutral, and there they've cut the target price to 868. The only upgrade is on Wipro, but again on Wipro, the upgrade is largely on attractive valuations. Even for Wipro, the Goldman has cut the EPS estimates by 1 to 3%. So, the big worry is that the dollar revenue growth is going to slow down from here, and multiples have still not corrected, and the valuations are expensive, and hence a big downgrade on TCS, Infosys, and Tech Mahindra by Goldman Sachs today.
Okay, all right. Thanks a lot for that, Nimesh. By the way, we had some news that was flashing for you on the screen. Sources to CNBC TV 18, the ED is conducting search operations in a lot of cities across the country. That's Mumbai, Delhi, Gurgaon, Kolkata, as well as Lucknow of Chinese companies facilitator. Searches include some gateway companies as well, payment gateway companies for specific transactions. And that's why Paytm is a stock that's suddenly seen a bit of a downtick in the last few minutes because the search covers certain premises of Paytm as well as PayU. So Paytm, the stock did see a bit of a downtick. Now, in fact, it's holding with a cut-off close around 1.5%. Gurmeet, any view on Paytm? First of all, when it came out with its issue, people were waiting for it. People who got it in the issue, I mean, hard luck for them because the stock is a third of what it was at. What's your take on the stock?
So Nigel, staying away for now, as I said, this market may not be very, favorable to companies which still are not clear on the glide path to profitability. I think if we see more traction in the payment business, I think lending also, they are very aggressive and a lot of it is co-origination. The easiest thing in India is to do credit growth aggressively. And then we have seen those cycles in a lot of NBFCs also. So I think we should see how this next growth lever which they're focusing on, which is lending and third party, plays out. There are better plays in financial, Nigel, if you want to play the fintech. I think CDSL to me is a better fintech play. We continue to add cross 10 crore demat accounts, seems to be a very structural play. Now we have insurance depositories coming in. So it's to me that's a better fintech play. When do you get 100 crores revenue at 60-70% EBITDA margins, right? That's great business to be in. Similar with CAMS, which again is a duopoly structure. As mutual portfolios go up, again a duopoly with Karvy and CAMS, CAMS having almost again 68% share. Some of the unlisted names may come in. We did take part in NSE unlisted some time back. And I think now insurance also seems to be slightly coming back, with the worst two period behind it.